You know, when you look at a weather radar, there's usually this comforting expectation of, like, epistemological clarity.
Right, a kind of shared reality.
Exactly. You look at the screen, and the data translates cleanly into action. Like, a green blob is moving east across the map, so you know it's going to rain.
Yeah, and a red center is forming off the coast, so you know a storm is coming.
Right. The data is objective, and therefore the consensus of reality is objective, right? You can plan your day around it.
It provides a shared baseline. I mean, even if people disagree on whether they actually like the rain, they don't disagree that the rain is falling.
Yes, the instruments are trusted. The interpretation is standard.
But I want you to imagine looking at that exact same weather radar screen.
Yeah.
And right over your house, the map is simultaneously rendering like a Category 5 hurricane, a sub-zero blizzard, and a sunny 75-degree day.
Wow. All occupying the exact same geographic coordinates.
Exactly. And half the meteorologists on your television are screaming at you to, board up your windows and evacuate immediately.
Right. While the other half are calmly telling you to put on sunscreen and head to the beach.
Yeah, that is a total collapse of consensus reality.
It really is.
When the recognized experts, looking at the exact same telemetry, arrive at entirely mutually exclusive conclusions, the system itself starts to feel like a hallucination.
The data basically ceases to be actionable and just becomes paralyzing.
Completely paralyzing.
Well, welcome to another deep dive. Today, you, our listener, are the person staring at that broken weather radar.
It's a very disorienting place to be.
Because our mission today is to unpack an incredibly dense, highly concentrated snapshot of the financial world as it looked right around mid-March of 2026.
And our source for this, it isn't a textbook.
No, definitely not. And it isn't a sterilized traditional financial white paper either.
Right. We are looking at a single video description and the surrounding page context from a channel on the Rumble platform.
A channel called Simply Bitcoin, which, by the way, has about 31,000 followers.
Yeah.
And the video we are analyzing is titled, rather aggressively, Bitcoin's short squeeze just shocked the market.
Which is a fascinating artifact purely from an anthropological perspective, let alone a financial one.
Oh, absolutely.
I mean, it captures a very specific high-tension moment in market history.
It really does. And for you, trying to stay informed without drowning in the noise, this single paragraph of text we're about to dissect contains a massive multi-car pileup of conflicting narratives.
It's a lot to take in at once.
It is. We are looking at an asset surging towards $73,000, wiping out short sellers.
Yeah, the mechanical violence of that is wild.
And at the same time, we have a prominent legacy strategist predicting a catastrophic crash.
While the video's own metadata tags predict a multi-million-dollar valuation in the exact same year.
It's just wild. And we have hostile politicians labeling the entire space of fraud, side by side with quiet institutional whales swallowing up billions of dollars in assets.
Right. Not to mention a definitive landslide legislative move by the United States Senate regarding digital currency.
Exactly.
Yeah.
So our job today is to decode the actual signal from this deafening market noise.
But before we delve into the market microstructure here, we really need to explicitly establish our analytical parameters for this deep dive.
Yeah, let's set the ground rules.
Because the source text touches on highly volatile political and financial rhetoric. It explicitly mentions politicians, a specific U.S. Senate vote, and, well, the whole platform.
Right. If you observe the surrounding alternative media ecosystem on this Rumble page, it's intense.
It features content from across a very polarized political spectrum. You've got Donald Trump, Newsmax, and Rebel News sitting right next to alternative science channels and live gaming streams.
Right. And to be absolutely clear, we are approaching this as impartial observers.
100%.
We are analyzing the mechanics of these arguments and the structural implications of the data exactly as they are presented in the text.
We are not taking sides.
No. And we are certainly not endorsing the viewpoints of the politicians, the media figures, or the financial analysts mentioned.
Our job is just to map the terrain of this ideological tug-of-war, not to join it.
Well said. Our focus is on the causality and the underlying logic behind these conflicting data points.
Right. We need to understand why these actors are behaving the way they are within this specific framework.
Okay, let's unpack this. We have to start with the most visceral piece of data in this snapshot.
The price action.
Yes, the explosive price action and the financial casualties left in its wake.
It's brutal.
The text states that Bitcoin just surged toward 73Ks, while traders betting against it get wiped out.
Yeah, wiped out is the key phrase there.
Now, for anyone tracking market mechanics, a short squeeze at these price levels isn't just a rally.
No, it's not people just getting excited and buying.
Exactly. I want to use an analogy here. Imagine borrowing a rare, highly sought-after vintage car from a friend.
Okay, borrowing the car.
You borrow it to sell it immediately, hoping that the value of that car is going to drop in a few months.
Right, you want to buy it back cheaper, return it to your friend, and pocket the difference.
Exactly. That's a short sale. But suddenly, the car's value skyrockets. The vintage market goes crazy.
Oh, no.
Yeah. And your friend says, hey, I need my car back. Now you are forced to buy it back at an astronomical price before you go completely bankrupt.
And your forced buying pushes the price even higher for the next guy who also borrowed one.
Exactly. It is a violent, structural failure of risk management on the short side.
Wiped out implies total margin depletion. We aren't talking about investors changing their thesis and deciding, oh, maybe I'll buy back in.
Right, it's not a choice.
No, we are talking about algorithmic liquidations. When a market is shocked by a short squeeze at the $73,000 level, the order book simply cannot absorb the forced buying.
So what happens mechanically?
Well, the exchange's risk engines just step in. They seize the collateral of the short sellers, and they execute market buy orders to close the position.
Regardless of the price.
Regardless of the price.
Which acts like a localized black hole in the order book.
That's a great way to put it.
Because if you are short and your margin account falls below the maintenance threshold, the exchange doesn't call you to ask your opinion.
No, there's no polite phone call anymore.
The algorithm just starts buying. And if the order book is thin, if there aren't many limit sell orders sitting at 70,000, 71, 72.
That automated market buy order just rips vertically through the available liquidity until it gets filled.
That verticality is what causes the shock.
Yeah. The cascading effect is brutal. One massive liquidation spikes the price by a few $100s.
Which immediately triggers the liquidation threshold of the next tier of short sellers.
Exactly. And their forced buying triggers the next tier. It is a domino effect powered entirely by involuntary participants.
But I have to push back on what this actually means for the asset's valuation.
Okay, let's hear it.
If we accept that this surge toward 73K is heavily fueled by this cascading algorithmic forced buying, these hostage buyers, essentially.
Yeah.
Then how much of that 73K price tag is genuine organic demand and how much of it is just a structural distortion?
That is the big question.
Right. Is this true price discovery or is it just a mechanical trap snapping shut?
Well, that is the perpetual debate regarding squeeze mechanics. A short squeeze inherently creates an artificial price premium.
Because they're buying for survival.
Right. The traders getting wiped out are buying to survive, not to invest. However, you cannot have a short squeeze without an initial, highly organic catalyst.
You need a spark.
Exactly. The baseline demand has to be strong enough to push the price up to the pain threshold of the short sellers in the first place.
Oh, I see.
The squeeze is just an accelerant. It takes a fire and throws a drum of kerosene on it. The fire was already burning.
So the bears fundamentally misread the underlying baseline demand.
Yeah, they got trapped.
And their punishment was being forced to fund the very rally they were betting against. It's a ruthless mechanism.
It really is. And it speaks to the immense danger of shorting an asset with a fixed supply cap.
Right, because traditional stocks are different.
Very different. In traditional equity markets, if a company's stock price squeezes to an absurd valuation, the board of directors can just authorize a secondary offering.
It could issue new shares.
Exactly. They flood the market with supply, crush the squeeze, and raise capital for the company all at once.
But Bitcoin doesn't have a board of directors.
No. And it has a rigidly programmed supply issuance. There is no mechanism to bail out the shorts by diluting the asset.
Right.
If the demand, even forced demand, exceeds the available spot supply on exchanges, the price simply goes parabolic until the margin calls are exhausted.
Wow. Here's where it gets really interesting, though.
Okay.
Because the financial warfare isn't just happening in the order books. It is happening in the narrative space. And the divergence is staggering.
Yeah, the text highlights this perfectly.
Let's look at the sheer epistemological divide presented here. We have an asset actively trading in the $73,000 range.
Right.
Yet the text immediately points out a Bloomberg strategist who is still calling for $10,000.
A massive drop.
And then, literally hovering above that text in the video's metadata, the Simply Bitcoin channel has a tag that reads, $10 million Bitcoin 2026.
What's fascinating here is that we are looking at a localized manifestation of paradigm incommensurability.
That's a big term.
Well, I just mean this isn't a minor disagreement over quarterly earnings projections.
It's a chasm. We have the apex predator of legacy financial media, Bloomberg, predicting an 85% catastrophic collapse.
And in the same breath, the alternative media source hosting the data predicts a 13,000% appreciation in the exact same 12-month period.
How does an investor, how do you, the listener, even begin to underwrite risk when the expert models are off by literal millions of dollars?
You have to recognize that they are not feeding the same data through the same model.
What do you mean?
They are using entirely different models of reality. The Bloomberg strategist calling for 10K is almost certainly applying a traditional discounted cash flow mindset.
Right, looking for yield.
Exactly. Or they're analyzing it as a high beta technology stock that is highly sensitive to macroeconomic tightening.
So in their framework, Bitcoin is a speculative risk-on asset with no intrinsic yield.
Yes. If liquidity dries up, or if the initial exuberance fades, the legacy model dictates a brutal mean reversion to its perceived fundamental value.
Which they calculate at 10,000.
Precisely. They are looking at it through the lens of the fiat system.
They are pricing it like a tech stock that doesn't pay a dividend.
Correct. But the framework producing the $10 million tag is entirely orthogonal to that.
It's completely sideways.
Yeah. They are not valuing it as a company. They are valuing it as a base layer monetary network.
A network poised to absorb the premium of every other store of value on Earth.
Right. If you operate from the premise that sovereign debt is mathematically unpayable and that fiat currencies are on an irreversible path to debasement,
then an absolutely scarce, non-sovereign bearer asset isn't a tech stock.
no, it's a life raft.
But hold on, let's play that out for a second. If the $10 million Bitcoin thesis actually materializes by 2026,
Yeah.
that implies a complete and utter hyperinflationary collapse of the US dollar denominator.
Oh, absolutely.
You don't get a $10 million Bitcoin in a functioning, healthy global economy.
That is the dark, unspoken corollary to hyper-bullish fiat price targets.
Right.
A $10 million price tag in that time frame doesn't mean your purchasing power has increased linearly.
It means the measuring stick is snapped.
It implies a catastrophic devaluation of the currency you are measuring it against.
So the legacy analyst at 10K believes the current financial system will ultimately subdue and normalize this volatile asset.
And the alternative media tag at 10K believes the asset will ultimately consume the failing legacy system.
And the retail investor is sitting at 73K, caught right in the crossfire of this ideological war.
Which creates a market environment driven by acute anxiety rather than rational capital allocation.
Because nobody knows which reality is going to win.
When the bounds of expectation are a 90% wipeout on one side and a global financial reset on the other, traditional metrics of risk management disintegrate.
Every price dip feels like the beginning of the end.
And every surge feels like the escape velocity of the new system. It breeds the exact psychological conditions that lead to the violent short squeezes we just discussed.
Man, that makes so much sense. And this massive disconnect isn't just theoretical. It is manifesting in the physical actions of the world's largest institutions.
Let's talk about that.
The text drops this absolute bombshell of a sentence. Politicians are calling Bitcoin a Ponzi, and institutions are quietly buying billions.
That sentence is incredible.
And right next to that, in the Rumble sidebar, another video title screams, 4M companies just forced to adopt Bitcoin.
The friction between public posturing and private capital flows in that sentence is arguably the most revealing data point in the entire source.
It is pure, unadulterated hypocrisy, isn't it?
Oh, without a doubt.
Let's analyze the game theory here. You have the political class, the people who regulate the markets, write the tax codes, and oversee the central banks.
And they're using the word Ponzi.
Right. That is not a casual descriptor. A Ponzi is a criminal enterprise.
Reliant on a continuous influx of greater fools.
Destined for mathematical collapse. And yet, simultaneously, institutions, the entities with armies of quantitative analysts, fiduciary mandates, and rigorous compliance departments.
They are allocating billions of dollars.
How does the listener reconcile those two actions occurring in the exact same space?
By understanding that politicians and institutions are optimizing for entirely different variables.
Okay, break that down.
Politicians optimize for narrative control, systemic preservation, and re-election.
Right.
The state derives a massive portion of its geopolitical and domestic power from its monopoly on the issuance of currency.
He who prints the money makes the rules.
Exactly. An ascendant, decentralized, non-state money is, by definition, a threat to that monopoly.
So labeling it a Ponzi is a rhetorical defense mechanism.
It serves to delegitimize the asset in the eyes of the electorate. It frames the state's eventual regulatory crackdown not as an act of self-preservation, but as an act of consumer protection.
So they're throwing sand to the gears of public adoption.
Precisely.
If you tell the average voter it's a criminal scam, the voter stays away, which buys the state time to figure out how to handle the threat.
Correct. But institutional capital does not care about the state's narrative preservation.
No, they care about yield.
Institutional capital is ruthlessly agnostic. It optimizes solely for risk-adjusted returns and alpha generation.
So if institutions are deploying billions, it means their internal risk committees have stress-tested the protocol.
They've analyzed the network effects and definitively concluded that it is not a Ponzi.
Right. A BlackRock or a Fidelity does not breach its fiduciary duty to buy billions of dollars of a known criminal enterprise.
Exactly. But you have to notice the phrasing. The text specifically says they are buying quietly.
That is the word that jumps out at me, too.
It's crucial.
If an institution takes a massive position in an emerging technology, they usually want to broadcast it to drive the price up.
Yeah.
Why the silence?
Well, there are two main reasons. First, the mechanics of accumulation.
Okay.
If you are an institution tasked with acquiring $1 billion of a highly illiquid, scarce asset, you cannot execute that on a public spot exchange without inducing massive slippage.
You'd spike the price and ruin your own cost basis.
Exactly. You have to accumulate through over-the-counter or OTC desks. You absorb the available liquidity in the shadows over months.
You want the price to remain suppressed while you build your position.
Yes, which leads to the second reason.
Let me guess. The politicians calling it a Ponzi actually provides the perfect cover for the institutions.
You nailed it. It is a phenomenal regulatory arbitrage.
The loud political fear-mongering shakes weak hands out of the market, keeping the price down.
While the smart money quietly scoops up the discarded assets at a discount.
That is wild.
And furthermore, operating quietly mitigates regulatory scrutiny. If the political class is openly hostile, an institution doesn't want to draw a target on its back by publicly flaunting its defiance of the political narrative.
So they simply build the position and wait for the regulatory weather to change.
Exactly.
And according to that sidebar video title, the one that said 4M companies just forced to adopt Bitcoin,
Right.
the corporate world might be moving even faster than the financial institutions.
Even allowing for the hyperbole typical of alternative media headlines, the underlying premise is huge.
Yeah, the premise is that adoption is shifting from an opt-in speculative bet to a mandatory operational infrastructure.
If millions of companies are integrating it, the political narrative of a Ponzi isn't just failing.
It being actively routed around by the commercial sector.
Which brings us to the inevitable countermove by the state.
Yes, the legislation.
If they cannot stop the adoption through rhetoric, they have to respond legislatively. And the text provides a massive data point on this front.
It says, meanwhile, the U.S. Senate just voted 89-10 against a government digital dollar. The signal is clear, and the market is paying attention.
This is a huge pivot.
So what does this all mean? I mean, an 89-10 vote in the U.S. Senate is a staggering, almost impossible level of bipartisan consensus in the modern political era.
It really is. They rarely agree on anything to that degree.
They can't agree on 89-10 for naming a post office, let alone the future of the macroeconomic monetary system.
Exacted.
To vote so overwhelmingly against a central bank digital currency, a tool that would theoretically grant the government unprecedented tracking, taxation, and programmable control over every transaction.
It's the ultimate tool of state power.
Right. So why would the state willingly lay down that weapon?
If we connect this to the bigger picture, it reveals a profound vulnerability in the political calculus of state surveillance money.
Okay, unpack that.
A government digital dollar is indeed the ultimate tool of monetary control. It bypasses the commercial banking sector entirely,
allowing the central bank to deposit or withdraw funds directly from individual citizens' digital wallets.
Right. It allows for programmable money, funds that can only be spent on certain politically approved goods, or funds that carry negative interest rates to force spending.
It is panopticon money, total financial surveillance.
Exactly. And the fact that the Senate rejected it 89-10 suggests two massive points of friction.
What's the first one?
the populist pushback. Politicians, for all their desire for control, are hypersensitive to the electorate's threshold for tyranny.
The Rumble crowd, essentially.
Yes. The alternative media ecosystem we see on this Rumble page, channels focused on liberty, anti-censorship, and government skepticism, represents a massive voting bloc.
So the political cost of attempting to implement a system that could theoretically freeze a citizen's wallet for attending the wrong protest or buying the wrong product
Was deemed politically suicidal.
The constituents basically said, if you try to track every dollar I spend, we will burn your political careers to the ground.
That is the populist read. But the second point of friction is perhaps even more powerful.
Which is?
The commercial banking lobby.
Ah, of course.
A government digital dollar disintermediates traditional banks. If citizens have a direct digital account with the Federal Reserve, why do they need Chase or Bank of America?
They don't.
Right. And the legacy banking system has immense lobbying power. They likely viewed a CBDC as an existential threat to their business model of holding deposits and lending against them.
So you have a strange bedfellows situation. The privacy-focused cypherpunks and the legacy megabanks both wanted the CBDC dead, albeit for entirely different reasons.
And the Senate folded.
But the text says the signal is clear and the market is paying attention. What exactly is the market deducing from this retreat?
The market is interpreting this as the removal of the apex predator.
The biggest threat.
Historically, sovereign nations do not tolerate competition to their currency. The assumption was always that if Bitcoin got too big, the U.S. government would launch a digital dollar.
And simultaneously criminalize private crypto networks to enforce a monopoly for their own product.
They would use the power of the state to crush the free market alternative.
But by voting 89-10 to abandon the state-sponsored digital dollar, the government has essentially declared a strategic retreat from the digital currency arms race.
They are ceding the digital settlement layer to private decentralized networks.
The signal to the market is that the U.S. government will not build a competitor.
And therefore, the primary existential threat to Bitcoin's dominance has just voluntarily removed itself from the board.
That is an astonishing concession of power by the state.
It's monumental.
And it perfectly sets up the next crucial piece of our text. If the state is stepping out of the arena, private enterprise is eagerly stepping in to build the infrastructure.
Let's look at who is actually funding this.
Right. Looking at the three specific sponsors of this video gives us a perfect cross-sectional X-ray of how this alternative financial microeconomy is structuring itself.
The sponsor list is rarely just commerce in this ecosystem. It is a declaration of ideological and industrial evolution.
Let's dissect them. We have three distinct pillars.
Okay, what's the first?
First, the Bitcoin way. The text describes them as an IT and cybersecurity team focused on simplifying the intricacies, allowing individuals to maintain complete control over their funds.
Self-custody.
Exactly. Second, we have Mining Disrupt, billed as the world's largest Bitcoin mining expo taking place in Miami.
Industrial scale.
And third, we have Ledn, a lending platform where you can borrow traditional fiat liquidity against your Bitcoin while retaining your position, offering a 0.25% discount.
This raises an important question about maturity. This triad maps perfectly onto the three necessary layers of a maturing alternative economy:
Which are?
ideology, industry, and financialization.
But I want to challenge the cohesion of this ecosystem.
Okay, go ahead.
When I look at these three sponsors sitting side by side, I see a glaring philosophical contradiction.
How so?
Well, the Bitcoin way is selling the fundamental cypherpunk ethos, right? Sovereign-grade privacy, holding your own private keys, eliminating counterparty risk.
Right, be your own bank.
The whole point is that nobody can freeze your account. But then you have Ledn, which fundamentally requires you to hand over your bearer asset to a centralized corporate entity.
You have to trust their risk management.
And accept counterparty risk just to get a fiat loan. Aren't these two sponsors completely philosophically opposed?
Yes, they are philosophically opposed, but an asset class cannot reach global scale solely on the backs of ideological purists holding cold storage wallets in bunkers.
Paranoia doesn't scale.
Exactly. What we're seeing here is the necessary stratification of the user base.
Ratification.
Yeah. The Bitcoin way represents the foundational layer one imperative. The option for total self-sovereignty must exist.
Because if you cannot independently custody the asset, it ceases to be decentralized money and just becomes another database entry in a bank.
That cybersecurity bedrock is mandatory for the system's integrity.
It's the ultimate escape hatch. The fact that you can hold it yourself keeps the centralized actors honest.
Precisely. But then you look at Mining Disrupt in Miami. This represents the industrialization of the asset.
We were talking about massive capital expenditure.
Grid scale, energy procurement, thermodynamics, and physical supply chains. The fact that the world's largest expo for this heavy industry is happening in a major U.S. city like Miami implies that local politicians are actively courting this hash rate.
They see it as a geopolitical asset.
A way to monetize stranded energy or stabilize local power grids. The asset has moved from digital abstraction to physical industrial reality.
It's heavy machinery now. It's not just code, it's infrastructure.
And finally, you have Ledn, which represents the pragmatic integration with the legacy world.
Because most people don't want to be their own IT department.
The vast majority of global capital does not want the operational burden of sovereign self-custody. They want yield, they want leverage, and they have real-world fiat liabilities.
Mortgages, payrolls, taxes.
A platform like Ledn allows a holder to access the purchasing power of their asset without triggering a taxable event by selling it.
It's rehypothecation. They're treating it like prime real estate.
Yeah, that's a good comparison.
You don't sell your skyscraper to buy a yacht. You take a line of credit out against the skyscraper.
Exactly. And the fact that an IT security firm advocating self-custody and a centralized lending firm advocating collateralization are sponsoring the exact same content.
It proves that the ecosystem has matured enough to support a highly complex, multi-tiered financial stack.
It is no longer a monolithic ideological bloc. It is a dynamic economy with diverse risk appetites.
Which is a perfect segue into the final and perhaps most fascinating layer of context in our source material.
The platform itself.
We've analyzed the asset, the market mechanics, the political hypocrisy, and the internal microeconomy. But we have to look at where all of this is happening, the physical digital terrain.
Right. This information is being hosted on Rumble.
The medium is inextricably linked to the message here.
Let's look at the environment.
Simply, Bitcoin offers premium-only content and go ad-free subscriptions on this platform. But the surrounding ecosystem in the sidebar is what really strikes me.
It is a chaotic, algorithmic collision of realities.
It really is. You have legacy alternative political media like Newsmax, Rebel News, and Donald Trump.
But sitting right next to them, completely unironically.
You have a gaming stream of Asmongold playing a World War I shooter, a channel called Exploring with Nug, searching for missing persons in rivers, a massive SpaceX Super Heavy launch stream, and Lo-Fi Girl.
It is the absolute antithesis of the curated, sterilized environment of legacy financial media.
Right. If you're watching Bloomberg television, every element of the screen, the ticker, the suits, the glass desks, the lighting, is meticulously engineered to project institutional authority.
It's designed to make you trust them implicitly.
But if you, the listener, are watching a highly technical breakdown of a $73,000 algorithmic short squeeze, and literally 1 inch to the right of the video player is a thumbnail of a guy streaming Call of Duty, how does that context alter the authority of the financial information you are receiving?
Well, for this specific demographic, it actually enhances the authority.
Really? How so?
To understand why, we have to look at historical parallels of information decentralization. Think of the Protestant Reformation.
Okay, going back a bit.
Before the printing press, the interpretation of the Bible was strictly monopolized by a highly centralized, ornately dressed, deeply institutionalized authority.
The church.
Right. The authority was derived from the exclusivity and the presentation.
We are the experts in the robes. You listen to us.
Exactly. But when the Gutenberg press democratized the text, the authority shifted. People began consuming the text in raw, unpolished, localized settings.
So the lack of polish was a feature, not a bug.
The very fact that the information was divorced from the pristine institutional architecture is what made it feel authentic to the reformers.
That is a brilliant analogy. The Rumble ecosystem is the digital printing press for counter-narratives.
When a viewer consumes financial analysis on Bloomberg, they are aware on some level that the information has been filtered through layers of corporate compliance, editorial boards, and advertiser sensitivities.
Right, it's sanitized.
But when they watch simply Bitcoin on Rumble, sitting next to a live, unedited gaming stream and an amateur river diver, the chaos of the environment acts as a cryptographic proof of authenticity.
It proves there is no centralized editorial board controlling the page.
Precisely. The visual friction of seeing a financial chart next to a SpaceX launch and a video game signals to the viewer, this is raw. This is unfiltered. This is outside the walls of the establishment.
So the 31,000 followers who are potentially paying for premium content here are actively placing a higher premium on decentralized, unpolished authenticity than they are on the sterilized credentialism of the legacy system.
They don't want the guy in the suit telling them what the weather is.
They want the guy standing outside in the storm with a smartphone camera. And the wild part is, looking at the 73K price action and the 10K Bloomberg prediction we discussed earlier, the guy standing outside in the storm on Rumble is empirically much closer to the market reality than the guy in the glass studio.
The decentralization of information delivery is perfectly mirroring the decentralization of the financial asset it is covering.
The legacy systems of both media and money are facing the exact same existential crisis of trust.
That's the real takeaway here.
Okay, we have excavated a massive amount of insight from this single snapshot in time. Let me try to synthesize this for you, the listener.
Well, we've covered a lot of ground.
We started by breaking down the brutal forced mechanics of algorithmic liquidations in a $73,000 short squeeze, exploring how forced buying creates violent price distortions.
We then analyzed the profound epistemological divide between a legacy system predicting a 10K crash and a network state maximalist predicting a 10 million valuation.
Realizing they are essentially arguing over the survival of the dollar itself,
we dissected the game theory of the state, calling the asset a Ponzi to maintain narrative control, while institutional capital quietly absorbs billions through OTC desks to secure their positions.
we looked at the U.S. Senate's 89-10 rejection of a government digital dollar, a stunning abdication of power that clears the runway for decentralized alternatives.
We explored the complex microeconomy of the sponsors, balancing the cypherpunk demand for self-custody with the industrial reality of hash rate and the pragmatic need for fiat leverage.
And finally, we examined the Rumble ecosystem itself, recognizing how the chaotic, unedited platform provides an authenticity premium that legacy media simply cannot replicate.
It is a perfect microcosm of a macroeconomic transition.
It truly is. And I want to remind you why this matters. You don't need to hold the asset, and you don't need to be trading the charts to be deeply affected by the currents we discussed today.
Everyone is going to feel this shift.
What this text reveals is a real-time, high-stakes renegotiation of the global social contract regarding money, privacy, and institutional trust. The foundational rules are being rewritten.
And as we close, I want to leave the listener with a final thought derived directly from the mechanics we've analyzed.
Leave us with a brain bender.
We noted that the text emphasizes how institutions are quietly buying billions, using the political Ponzi rhetoric as cover to accumulate without spiking the price.
Right.
But mathematical scarcity dictates that the OTC desks will eventually run dry.
So what happens then?
What happens to the market structure and what happens to the extreme price volatility when those institutions finish their accumulation phase and decide they no longer need to be quiet about what they hold?
When the whales finally decide to surface and breach. That is a truly staggering thought.
Is coming.
Keep questioning the consensus, keep looking for the underlying mechanics driving the noise, and remember, when the weather radar breaks, you're going to have to learn how to read the clouds yourself. Thanks for joining us on this deep dive.